Hello, good evening. Good evening, everyone. So, in this short lecture, I'll explain the related fields to the financial management. What are the other fields, the knowledge of which is necessary to succeed as a finance manager or a CEO? So, it is not sufficient for a finance manager or a CFO of a company to have the knowledge of only financial management. Okay, financial management is not an independent discipline or independent area. Financial management is not an independent field. It is an interdependent field. Financial management is not an independent field. It's an interdependent field. Success in financial management requires the knowledge of various other fields. Success in financial management requires the knowledge of various other fields. But out of that various other fields, I took only those three important: accounting, quantitative methods, economics, etc. So there are many fields the CFO should have knowledge: production, marketing, operations, etc. But I have taken for this brief discussion, I have taken these are the important fields. A finance manager should have the knowledge of accounting, quantitative methods, and economics. And I have deliberately put this in a proper order. Will deliberately put this in a proper order. At a basic level financial analysis involves accounting knowledge. A basic level financial analysis involves accounting knowledge. Medium level financial analysis requires quantitative methods knowledge. Middle level management. Okay, so bottom level management, okay, accounting. So middle level management is quantitative methods, and top level management is economics. Top level management is economics. This is how deliberately I have organized it. So at a basic level, if you are a finance professional, if you have recently entered the career, yes, should have an accounting knowledge. Must and should have accounting knowledge. In your mid stage of the career, you will be using more of quantitative methods. In your mid stage of the career, you will be using more of quantitative methods. In your higher stage of career, in your peak stage of the career, you will be using more of the economics. You will be using more of the economics. Okay. So therefore, I took these are the three important fields, the knowledge of which is very much necessary to succeed as a finance manager or a CFO. Okay, right. So first we'll start with the basic level. Accounting. Accounting and finance are interrelated. Sir, how accounting and finance are interrelated? Very simple. Accounting and finance are interrelated. So how finance and accounting are interrelated? Financial management, accounting. So first accounting entries happens based on the transactions entered. So we will take a decision as per the financial management. Decision is taken, decision is implemented, transaction is occurred, and transaction is recorded. Okay. So here what are the point? Decision taken, financial management, decision taken. Okay. Decision implemented, transaction occurred, decision implemented, activity or transaction occurred, an accounting or financial transaction occurred, transaction monetary impact, transaction occurred having a monetary impact. So now this accounting function records this transaction. Okay. So first financial management, decision is taken, that decision is implemented. So if the decision is implemented, transaction will happen. So if that transaction is recorded in the accounting, right? So this accounting produces the feedback to the financial management. Okay. So financial management talks about planning. Basically, I can say financial management is about planning. We are planning, and this accounting shows actual performance. Okay, actual performance. So first plan, perform, then revise the plan. If your performance does not matches with your plan, then we have to change the plan. As simple as that. Okay. So if this method does not work out, you have to work out in a different way. So this financial management gives inputs for future decision making. So financial management evaluates the impact of past decision. Accounting evaluates the impact of past decision. So if based on the impact of the past decision, we'll take future decisions. So therefore, this is how the cycle rotates. Financial management decision is taken, accounting will give the impact of the decision. Based on that, financial manager will revise the decision. If the decision works out, yes, he will continue with the same method. If the decision does not work out, he will change it. So therefore, this is how the financial management is input to the accounting, and again accounting is the input to the financial management. Okay, right? Financial management decisions causes accounting entries. Financial management decisions causes accounting entries. So accounting impact, impact of the decision as disclosed by the accounting function is used by the financial management again for decision making as a feedback mechanism. Okay, so financial management causes an accounting entry. Okay, and the impact of the decision as reflected by the accounting function will be used by the financial management for future decision making, for evaluation of past decision and for future decision making. Financial management uses the accounting for evaluation of past decision, and indirectly it uses that feedback for future decision making. Okay, so financial management uses the accounting for evaluation of the past decisions, for evaluating how successful the past decisions are. So based on that feedback from accounting, financial management will refine their decisions. Based on the feedback from accounting, financial management will refine the decisions. Okay, so this is how the financial management and accounting both are interrelated, right? So basically, financial decision accounting happens. Accounting records what happened in the past. Financial management decides what will happen in the future. Okay. So first, so whatever is future today, for tomorrow it is a, for day after tomorrow it is a past. Today I am talking about future. Today I am talking about tomorrow. So for me today, tomorrow is my future. Tomorrow is the future for today. So tomorrow is the past for day after tomorrow. As simple as that. Tomorrow is the future for today, and tomorrow is the past for day after tomorrow. So therefore, financial accounting discloses what happened in the past. Financial management will analyze what will happen in the future. Okay. The common point between the accounting and finance is this financial statements. So this financial statements produced by the accounting is used by the financial management. Financial statements produced by the accounting function will be used by the finance management. Financial statements produced by the accounting function will be used by the financial management for evaluation of past decisions and also for taking better future decisions. Okay, so these are the difference between accounting and financial management. Accounting is basically accrual based. So accounting is basically accrual based. Whether or not cash is received or cash is paid, will record the transaction. So irrespective of the cash exchange, transaction is recorded. Transaction is recorded irrespective of the cash exchange. Financial management is records only when the cash exchange happens. Accounting is past orientation. Financial management is future orientation or forward looking. Accounting involves collecting, classifying, and presenting the data. Accounting involves collecting, classifying, and presenting the data. So financial management analyzing such data and applying the feedback from such data for future decision making. Applying the insights from such analysis, okay, for future decision making. Accounting basically uses only internal data, whereas financial management uses both internal and external data. So this is how the accounting and financial management both are related at the basic level. If you start your career in the finance field, at the basic level, you should understand the accounting. Because at the basic level, your job is to compute the ratios and analyze the financial statements. Okay, at an entry level finance professional, an entry level finance professional's job is to analyze the financial statement. That is an entry level. That is an entry level job. Okay, right. Next, so as you move on your ladder in the corporate career, definitely you should understand the quantitative methods. Definitely, you should understand the quantitative methods. Sir, why I need the quantitative methods? Very simple. Today the data is becoming voluminous, and data is giving different signals, complicated signals, multiple signals. To get the summary of what the voluminous data says, to get the summary or message of what a complex data conveys, we need quantitative methods. So quantitative methods is a communication between the finance manager and the raw data. Okay, so raw data will be processed by the quantitative management and will throw an input or summary to the financial manager. Okay, raw data, voluminous and complicated and diversified multi-level data is analyzed using quantitative methods, which can be the summary. The quantitative methods will throw the summary or message from the voluminous and complicated data. The data is voluminous and the data also conveys different signals, complex data. So therefore, quantitative methods are necessary quantitative methods are necessary, because now the data is very huge. It is without the help of quantitative methods, it may not be possible to analyze the data. Okay, so simply speaking, quantitative methods throw the summary message conveyed by the raw data. Quantitative methods throw the summary message conveyed by the raw data to the finance manager. So based on that, finance manager can take the decision. Okay, so this is the financial management versus quantitative methods. And last but not the least, when you move to the higher level, peak levels in your career, when you move to the higher level or peak levels in your career, definitely must and should you should have the knowledge of economics. Definitely must and should you have the knowledge of economics, because decisions are taken, most especially for a large organizations. For a small organizations, the knowledge of the economics may not be necessary. But if you are a finance manager or a CFO of a large organization, okay, so for a small organization, the knowledge of economics may not be necessary. They are operating in a closed circle. They are operating in a closed circle. But for a large organization, CFO or a finance manager, the knowledge of economics is very much important. Very much important. Without the knowledge of the economics, you cannot take a decision. So without knowing what happening in the world, what may happen in the coming 5 years or 10 years. So based on this, you can take a decision. Demographics, people age group, composition, people tastes and preferences, decisions taken by various countries government, decisions taken by various countries bankers, and the impact of that, and the people's spending habits, lifestyle changes, everything has to be analyzed. Everything has to be analyzed. Be clear, there are 2 points here. One is feasibility versus viability. Feasibility versus viability. The difference between successful and failure people lies, one of the difference is this point. Failure people will focus only on the viability, whereas successful people will focus both on viability and also feasibility. Failure people will focus only on the viability. Successful people focus both on the viability and also the feasibility. Sir, what is the difference between feasibility and viability? Okay, so if I do a business, if this business is done, whether I can get the profits or not is a viable decision. Whether a particular business gives profit or not, that is a viable decision. Whether I am capable of doing that business is not feasibility decision. Do you understand, ma? Whether a particular business gives profits or not, that is a viability decision. Whether I can do that particular business or not is a feasibility decision. Okay, therefore it is very important to analyze both feasibility and viability. No doubt, petrochemical business, oil business is very much profitable. Okay, Mukesh Ambani is getting good profits, but I cannot do the profits. I cannot do that business. It's impossible for me. But at the most, I can start an education institution, or I can do some private coaching or tuitions, etc. Or I can give tax advice to a client. This much I can do. I can't. It's beyond my reach. It is beyond my reach. Running that large-scale petroleum business is beyond my reach. Therefore, even though the business is viable, but it is not feasible for me. Business is viable, but it is not feasible for me. Business is profitable, but not possible. Profitability versus possibility. Viability refers to profitability. Feasibility refers to possibility. Okay. So first of all, feasible. Feasibility refers to profitable. Possibility. Feasibility refers to possibility. Viability refers to profitability. Viability refers to profitability. Viability refers to profitability. Without economics knowledge, okay, without economics knowledge, I cannot analyze this feasibility. Sir, that business will give much profit, sir, good sales, less cost, high profits. Yes, but I can't do it. I can't do it. So the production manager comes, okay, he will ask for a new machinery. You have to analyze the feasibility, whether our organization will have sufficient and competent staff to operate that machinery. Okay, so what is the noise and air pollution generated by the machinery? Based on that, what is the impact? What is the government policy will on that? If I import this machinery now, what would be the government policy decision in future? Whether in future government will accept this kind of machineries or not? These are all you have to analyze. Okay, so what is the impact of the RBI decision? What is the impact of the government decision on my cost of borrowing, on my borrowing cost? So today my borrowing cost is 10%. Depending on the 10% borrowing cost, I cannot do a particular business. I have to predict what would be the borrowing cost in the coming decade or 5 years at least. Okay. So based on the today's scenario, I cannot take a decision. So today's decision depends upon, is taken based on the prediction of the future position. Okay, today's decision is taken based on the prediction about future position. Okay, so that future position is conveyed by the economics. Only with the economics knowledge you can understand what may happen in future. Okay, right? Within the with the economics knowledge and within the macro context only, we can take any good financial management decision. Okay, therefore, as you reach higher level positions in the organization, the knowledge of economics is very much important. Okay, thank you. See you.